For all the people who bought gold at $5,000, you need to see this. There are a couple of important Wall Street indicators that are showing that there is a possible chance for replication of one of the gold crashes from the past. Gold has a couple of different crashes, but the most severe one appears to be the crash around the 1980s. This pattern from 1980s is very similar to the current pattern, and the reasons for the crash in 1980s, it most likely will be the same now in 2026. Very important elements over here. So if you look at the numbers, the prices of gold and silver have completely mirrored the price action in the 80s. They had a 30 to 70% plunges after the rally, something we saw 2 weeks ago. Also, we saw that the liquidity was crushed, which meant a lot of people got scared and didn't want to buy in the dip. Second important thing is that the reason for the big crashes in 1980s was the Federal Reserve. There was a change in the Federal Reserve, and surprise, surprise, the Federal Reserve will get its new chair in May. So this is very, very important, and it's kind of weird that no one else pays attention to. It's very obvious that something big is coming and something it is going to change. It's no longer be the same as it is right now. Here is the brief introduction and historical elements. First of all, in 1980s, there was a big bubble worldwide economy, right? So people were trying to hedge against potential turmoil, potentially losing on their savings or retirement. Gold at this very moment became $850 per ounce, which at that time was at all-time high. Something very similar, currently gold is, or it was a month ago at its all-time high. Why it was? Because people were what? Again, afraid of big world turmoil. They were afraid that the dollar will continue losing its value. They were afraid that the economy will change substantially and the stocks will crash and the crypto will crash. And this is why people bought gold and silver. They bought the gold and silver for the same reasons in 1980s. But what happened next? It's mind-boggling. The gold fell from $850 down to $297. This was 65% crash. I want you to picture this, right? You put $100 and effectively you're losing 65% of your gains. And this is not because there is something wrong with the gold. This has to do with the people investing in gold and silver, because they always artificially increase the price. They don't increase the value of the gold and silver. The value of precious metals is constant, doesn't go up, doesn't go down, regardless of the demand, regardless of the supply, regardless of the actual physical findings or non-findings. The demand is kind of constant and it's not actually growing if you pay very close attention. Because there's a recycling period where a lot of the old jewelers, if we spoke about physical, because a lot of people would try to make the case that there's more demand for jewelers and this and that. People are melting old jewelers, old gold, old silver to make new stuff. So it's kind of a recycling theme. You don't really need so much more demand or so much more materials to build brand new gold items, right, or silver items. Second important element over here is that the market crashed in 1982, 2 years after the new all-time high, simply because the Fed chair, which was Volcker, he hiked the interest rates 20%, which effectively destroyed overnight the price of gold and silver. He effectively made the dollar great again, right, which is something that's going to happen very, very soon. And he sparked a 20-year bear market. And this is a 20-year bear market in particular about gold and silver. Sure, the stock market also suffered, but the stock market recovered fast because there is an actual business behind the companies who people hold the stocks from, right? There is a reason why or if some of these companies will recoup the losses, but there is no strategic or psychological reason why if gold and silver fell 65% or more, you will be expecting something to recover. There's no earnings that you can track. There is no productions you can track, especially people who are just betting on the paper, right, in the futures market. All these people will most likely be liquidated, right? These people are effectively losing almost everything that they are invested in. And if we go back to the people who are producing and manufacturing, for them it's actually favorable gold and silver to crash because the prices will become lower. When the prices become lower, they can actually buy more and produce goods with the gold and silver, and then when the prices rebounds, they can actually charge much more because the upside is greater. If you produce something when you purchase gold at, let's say, 3,000, and then the gold goes back to 4,000, you're still selling the same jewelry for the same price, 10k necklace, 15k bracelet, but your cost basis is 1k 2k lower, so you actually make more money. So I genuinely believe that people who are dealing with the actual day-to-day business from the industry, from the physical gold and silver, have even greater interest than Wall Street to see gold and silver prices crashing. This is very important for their also averaging down the cost basis. They will be actually able to produce even more, which, as you may have guessed, will reduce the prices. When you have more suppliers selling the same bracelet with the same design, right, the prices will go lower. But that's not really a big thing, because if you really think about the cost basis also will be lower, right? So if lower cost basis, if you don't produce something unique, something custom, right, the prices will also kind of go down. The market will price it down, but still you will be in better position, because lower price always locked up less capital. When you have less capital that is locked and more capital that is free, available to bounce off if something went wrong, well, it is always good for the business. This is how you stabilize the market, and this is how things should work as well on the real estate market. The real estate market hasn't crashed since 08, 09, and this is the problem. The real estate has been going up and up and up and up and up, and people couldn't afford the real estate. This is why the real estate also should crash and should be re-evaluated from the banks who gave up the loans, from the developers who built the buildings, and from the landlords who are actually lending the properties. The market should be repriced with the current wage growth, which is slowing down. The wage growth is slower than the inflation growth. This is what actually makes people poor. Inflation can go as high as it wants as long as the wages are growing higher than inflation. If inflation goes up 100%, but your wage growth is 150%, you ain't gonna feel any difference, right? Sure, you will spend more money for less items. Physically speaking, you will go with one big bag to buy a TV. That's something you usually buy with, but it's a small pocket of change foldings, right? So this is what I'm trying to explain. Everything should be repriced to the fair value, and everyone will benefit from it, except the speculators. But who cares for the speculators anyway?